From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. A constructive tone to the markets because nothing collapsed. Everything was fine over the weekend, and so you are seeing banks outperform. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Coming up, First Citizens Bank injecting fresh optimism into markets. U.S. authorities said to be considering additional support for First Republic as Fed speak returns with a warning on recession risks. We begin with the big issue, closing out a volatile month of March.
The volatility, I got to tell you, it is pretty crazy.
The bond market's volatility here recently.
The bond market is pleading with the Fed to cut rates.
The bond market is somewhat, dismissing the Fed's dot plot.
The market is on a hair trigger waiting for the pivot.
I think we're going to get a lot more volatility.
People see, different statistics being reported from an economic standpoint.
We're entering a period of higher economic volatility.
And then they see stories about Credit Suisse, stories about Silicon Valley Bank.
The volatility in bank spreads.
The banking sector is really, it runs on confidence.
Whether it's rational or not doesn't really matter.
A lot of sentiment and a lot of emotions.
The volatility is still going to be with us for a while.
Because right now, the markets and Fed are playing a game of chicken.
The key question is who is right in that scenario?
Joining us now, TPW's Jay Pulaski and Ella Hoja of Pictet Asset Management. I love having both of you here because we have a bull, we have a bear, we have people who look at the same picture and come up with a very different scenario. Jay, I want to start with you. Everyone talking about the banking disruptions causing a potential pause in the Fed's rate hikes, possibly rate cuts. You see this as the moment you've been waiting for. Please explain.
Yes, Lisa, thank you. I think we're moving through the COVID period. Or we have moved through the COVID period. We're moving through the inflation period. And SVB and Credit Suisse have acted as a fire break. They've proven to the Fed that certain parts of the economy, namely the big winners from the ZIRP and work from home era, cannot handle rates any higher than where we are. So the Fed is now effectively done while the rest of the economy is in pretty good shape. Housing has bottomed. Supply chains have unsnarled. Manufacturing is doing well. I read a quote over the weekend. There has never been a better time to build a factory in America. That actually came from Volkswagen. So there is an awful lot going on, and I think we're moving into a high nominal growth economy. We're not going back to the 2010 low growth, low inflation. The Fed is going to move off its 2% inflation target. It's totally arbitrary. And I think we're about ready to break up and out. The market has had every opportunity to break down. It has not done so. If I was a bear, I'd be very worried. I think we're going to be led higher by the cyclical and other segments of the market that have been priced for recession, a recession which is not going to happen.
All right, Jay, there's a lot to unpack there, but I'd love Ella to weigh in here, especially because, Ella, you are more cautious on your outlook and in your investment allocation. So how would you punch back at what Jay was just saying, which is basically, well, you should be worried?
Right. I mean, for us, it's a very classical boom-bust scenario. And typically in monetary cycles, when the Federal Reserve tightens a lot, and in this case, other global central banks, we tend to have a bit of a blow-up scenario. And that's kind of manifested now in banks. Last year, it started in the tech sector. So the market, at least the bond market, is telling you you're already pretty tight. And certainly the bond market has a very good track record, particularly in terms of the curve inversions and telling you where the economic cycle might be going. So we believe that we're probably pretty close to a contraction. And what's happening in banks is reflecting that. And the cost of borrowing for banks is going to go up substantially given the recent turmoil. And that tends to feed into more expensive credit for the economies. And so for us, that's just preceding a bigger slowdown down the road. And so we think that is not a good mix for risky assets. And so we'll definitely take the other side to what Jay is saying, that maybe we're in different continents, I guess, so different takes.
Well, Mike Wilson is on the same continent as Jay Pulaski, and Morgan Stanley's Mike Wilson seeing more risks ahead for stock earnings. Take a listen to what he had to say.
Last year, we saw a pretty big degradation in multiples, but as we pointed out again today, all that was due to higher interest rates. None of it was due to higher risk premium, which is the part of the multiple that is, pricing in what growth is going to be. The market is starting to revalue or devalue what I would say the companies that are most at risk of missing estimates. And because the bond market just repriced itself overnight, we think that risk for the equity market is elevated now more than it's been for the last 6 or 12 months.
So, Jay, how do you take a look at what some people are looking at with respect to more expensive credit, as Ella is pointing out, and the potential for earnings to decline in the face of the expected tightening, the expected decline? How do you take a look at that and say, look past it? It's not going to matter.
I don't say look past it, Lisa. I say don't expect it. To Ella's point about the central banks, look, we have 4 major central banks in the world. The Fed and the ECB are tightening. The Bank of Japan and the PBOC of China are easing. I'll quote you the S&P Global Composite, which just came out for the month of February. It was at 53. 50 and above indicate expansion. We are not in a contracting economy. We're actually in an expanding economy. And yet people just refuse to kind of recognize that reality. And the bears like Mike Wilson, who I respect, but he's been bearish forever. And the market has refused to go down. So I think if we're not going into recession, and look, Morgan Stanley, Goldman Sachs, and others have come out and bounded what they see as the risk to this kind of credit contraction that people keep talking about. It's in the tenths or 0.2 of a percentage point for the year towards the end of this year, Q3 and Q4, 0.2 of a percentage point. So that is not a reason to change your allocation. And people love to talk about cash. Cash is underperforming global equities by 260 basis points year to date. It's not the great asset that people keep talking about.
But Ella, some people have argued that on the cash side, at least you're getting about 5% yield. Now that cash levels have come down a little bit, or at least if you look at 6-month T-bills, we're looking at 4.6%. When do you know what's attractive? What's your sort of benchmark case for where Fed funds will ultimately end up, where inflation is going to be, and what you should target in terms of a return bogey?
Well, it's quite simple for us. It's very rare in markets that you get opportunities where it's difficult to beat cash. And that's certainly been the case recently. So there are pockets, for example, in bond markets, so in high yield, where you're starting to carry a little bit now. But given the backdrop of economic risks, that's still not attractive to us, not yet. But anywhere else, if you look across the yield curve, I mean, the 2-year yield that you have on the screen here, it's basically difficult to beat cash and very difficult for global bond managers like ourselves to actually find the right solutions given the risk reward available. And if I look at the equity space and you look at earnings yield there, that also struggles to beat cash in the context of what we believe to be a slowing down of the global economy. So for us, actually, it's hard to say, but cash is not trash, I think is very valid here.
All right, well, we're going to carry this conversation forward. Meanwhile, markets are poised for another volatile week. Plenty of Fed speak on the agenda. Minneapolis Fed President Neil Kashkari kicking things off just yesterday, sounding the alarm about a possible recession. Take a listen to what he had to say.
What's unclear for us is how much of these banking stresses are leading to a widespread credit crunch. And then that credit crunch, you're right, just as you said, would then slow down the economy. This is something we are monitoring very, very closely.
So this is the big question. How much is this going to really bake in rate hikes, sort of effective rate hikes into the economy? Michael McKee joining us now. Mike?
Well, Lisa, we are going to be watching Fed bank deposit information and the Fed balance sheet information and the senior loan officers survey going forward, as that bank question is the one that's hanging over the markets. Here's where we are. Of course, we had a meeting last week. It was the most anticipated Fed meeting in years and years, and the Fed chose to fight inflation over propping up banks. They raised rates. Markets now have decided, those who trade in overnight index swaps and Fed funds futures have decided the Fed's crazy. They're pricing in rate cuts by the end of the year. Banks look like they're going to open the week higher, but the fallout, as President Kashkari said, remains unclear. So where does that bring us? To the most anticipated Fed meeting in years on May 3rd. So we've still got a month, 6 weeks really to go. What's going to happen during that week? Well, one of these two lines is going to move, and it's not going to be the green one. The green one is the Fed dot plot median. The red one is what the overnight index swaps are pricing for Fed rates, and it looks like they are significantly below where the Fed is with those rate cuts priced in. But as the data come in, we'll see where they move. Do they move up towards the Fed or farther away? And speaking of data, here's our calendar. This week, we hear from a number of Fed officials. One of the more interesting ones, Michael Barr, tomorrow on what happened with SVB. But most of these things won't matter. The PCE numbers at the end of the week probably matter more to the markets than these speeches, because the speeches are going to have to change depending on what the data say. And you can see at the bottom of the, or I guess on the right-hand side of that chart, where the big data points are going forward, Lisa.
Yeah, the PCE inflation is going to be really key. And then, of course, everyone's just waiting for the senior loan officer survey on May 8th. Mike McKee, thank you so much for that. Jay, I want to go directly back to you. Ella and Jay both still back with us. But Jay, you were talking about how you don't believe that this Fed has the stomach to go all the way back down to a 2% inflation rate, that essentially this is the beginning of abandoning that peg, despite the fact that Fed official after Fed official have come out and said, we are not going to abandon the 2% peg. What makes you think that we're effectively going to do that? What sort of is the concern that overrides the desire to bring price stability back to that level?
Well, Lisa, I think the important thing for the audience to recognize is that it's a completely arbitrary number, right? That has only been in place for the last decade. It was accepted by the Fed in 2012. It's completely arbitrary. There's nothing that says that 2% inflation is the right level to have. It could be 3, it could be 4, it could be 1. It's totally arbitrary. So I think that the important point is, as I noted, SVB and Credit Suisse, particularly SVB, Credit Suisse has been the sick man of Europe for a decade, is showing that certain segments of the economy, which really benefited from the zero interest rate policy, cannot absorb higher interest rates because they're already breaking. And so to me, that allows the Fed to continue to see inflation come down. We expect at TPW for inflation to continue to decline through the rest of this year and end up around 3% by the end of 2023. And we think the Fed is not going to come out and change and state the change. They will just allow for the inflation rate to be at that level. And this is something, Lisa, that has been in discussion amongst the policy and academic circles for much of the last year. And you've had people like Oliver Blanchard, former chief economist of the World Bank, come out and say that the Fed should do exactly that. We're approaching a new high nominal growth rate world, and therefore the policy mix of the 2010-2020, when 2% was introduced, is not appropriate for the environment we're going into.
Well, Ella, I'd love your response to this, especially from a European vantage point, where we heard Isabel Schnabel, as reported by Bloomberg this morning, was actually pushing for the statement from the ECB to include that rates were going to go even higher from here. Do you think that there is a greater aversion in Europe to allowing inflation to remain above that 2% target?
Probably the opposite is true, actually, Lisa. I think, a lot of respect for Schnabel. She's been a good guidance for markets and a very centric in terms of the ECB debate and to help us navigate that debate. But Europe faces constraints. If you look at the banking system, the European-wide deposit guarantee scheme is not exactly there, and it's in the same setup that you have in the US. And in terms of Europe, you're as strong as your weakest link is still valid. You have, the periphery that's bearing quite a bit of debt. So I don't think that a very, very high interest rate environment is viable for Europe. So on a relative basis, we would actually say that Europe may have to suffer more inflation. But just to quickly pick up on what Jay was saying, so this 3 to 4% inflation argument, you're assuming that the bond market is going to sit back and take that, right? So we have a big regime in central banking speak, and we say 3 to 4% is the new norm for inflation. I would see a very bearish setup for bonds, in which case it's very difficult to not see risky assets be taken down with that.
Well, a lot to dig into. Ella and Jay, both of you are staying with us, Jay Pulaski and Hela Hoja. Coming up, a fresh dose of hope for the banks.
Silicon Valley. The FDIC was able to sell that over the weekend to First Citizens. So both of the failed banks have now been sold to private banks or banks that are publicly traded. So we're moving in the right direction.
More on that conversation coming up next.
The crisis has really quieted down, and I think as the deposit flight has pretty much, I think we're going to find by the end of this week, slowed down to a trickle. It is calming down, and you saw, of course, that Silicon Valley, the FDIC was able to sell that over the weekend to First Citizens. So both of the failed banks have now been sold to private banks or banks that are publicly traded. So we're moving in the right direction. Is it the all clear signal? Probably not, but we're getting darn close.
First Citizens' purchase of Silicon Valley Bank capping 2 weeks of turmoil in the banking sector. But shares of some of the most battered lenders are rallying in pre-market trading. First Republic leading the move higher amid word that more support for banks could already be in the pipeline. Bloomberg reporting, quote, U.S. authorities are considering expanding an emergency lending facility for banks in ways that would give First Republic Bank more time to shore up its balance sheet. Team coverage starts right now. Bloomberg's Anne-Marie Hardern alongside Kaylee Linesdown in D.C. Kaylee, I want to start with you. What's the latest?
Well, of course, you had the news about, or the reports at least, that the U.S. government is looking for ways that it could help shore up First Republic, help that bank to survive. We also finally got the news that the FDIC found a bidder for the failed Silicon Valley Bank after a number of weeks. First Citizens agreeing to take all of those $72 billion in assets at a discount of $16.5 billion, which is why we are seeing in pre-market trading, of course, we're showing the Friday moves here on the board, but in pre-market trading right now, First Citizens is up 53%, while First Republic is up by 30%. And you have other regional banks like PacWest and Western Alliance higher as well. Of course, these moves only go so far to undo the damage we have seen over the course of the last several weeks. The regional banks, as a Spider ETF, is down by about 28% over the last 3 weeks, even more than that over the last year. It is underperforming the broader financials because, of course, it is these regional banks that we were concerned about deposit flight and whether or not they could remain healthy and solvent. And, of course, we saw evidence of that deposit flight in data out on Friday. Granted, it was only data on deposits through March 15th, which was, of course, the week of the collapse of Silicon Valley Bank and Signature Bank. We saw a record weekly drop in deposits for smaller banks of $120 billion. That's about 2% of the deposit base. So the question now, Lisa, becomes, has enough been done to stop the bleeding?
Which is the question that brings us to Anne-Marie. Anne-Marie, are there discussions ongoing about deposit insurance, about other measures to shore up the system, or is crisis over? Let's move on.
Well, certainly it's not crisis over, right? And our reporting over the weekend is that officials are keeping a very close eye on First Republic to the point where they may start to amend this lending facility at the Fed so they could shore up the bank. But they are not concerned about the severe flight we saw in deposits of Silicon Valley Bank, which, of course, the FDIC had to step in there. But they are still looking at potentially what can be done with First Republic. And this is one option that they are weighing, Lisa. We should note there has been no decisions. There's going to be a ton of hearings, though, today. So this is not, this week. So this is not going away in terms of lawmakers wanting to look at with the regulators on what went wrong. But we should also look at what Secretary Yellen said last week. She made it pretty clear that if warranted, regulators and the U.S. government will step in.
All right, Anne-Marie, Kaylee, both of you, thank you so much. Moody's Analytics chief economist Mark Zandi tweeting yesterday, the banking crisis is not over. Depositors remain on edge and continue to pull deposits from banks, moving their cash to money market funds. Money fund assets jumped again in the week ending last Wednesday and are up more than in the past 2 weeks than any time, save in the pandemic shutdown. Still back with us, Jay Pulaski and Ella Hoja. Ella, I want to start with you. How concerned are you about ongoing stress in the banking system?
Obviously very concerned. It remains the epicenter of how you transmit credit into the economy. But, having said that, we've seen repeated actions to try and shore up the banking system. So certainly when it comes to the U.S., we believe that eventually that will be done, right? So we will buy some of the confidence back from investors. It's a little bit more tricky in Europe, but it won't be for lack of trying. So we're seeing similar types of actions and tools available in Europe as well. Now, Having said that, can you always get an accident? Of course, that's possible. But we would actually say that there's very little appetite to have a full-blown banking crisis. What concerns us over and beyond the banking sector, however, it's issues that pertain more to where the mispricings in assets have been over the course of the last 10 years plus. And that's effectively started with tech last year, and it's likely to feed into private assets, but it's more likely to be a drip case of weaker price action there rather than a full-blown immediate event.
Which is sort of the drip that people are expecting from credit tightening as well. Jay, from your vantage point, do you see this as a potential opportunity that the banking system is strong and that you can go in and take advantage of some of the dislocations in smaller and medium-sized banks? Or do you see this as needing to continue in order to get the Fed to truly back off the way you're talking about?
No, Lisa, we've been focused on the large cap banks, both in the U.S. and Europe for some time. We continue to hold both XLF and EUFN. As you know, we focus primarily on ETFs. Those are the U.S. and European bank ETFs. And to our view, we don't see the risk of any widespread systemic problem, in large part because there are no major imbalances in the economy, whether it's consumer, whether it's corporate, whether it's the banking sector. There's nothing systemic. There's been no deregulation or dramatic deregulation. There's been no loosening of lending standards. I do think there is a commercial real estate issue. We're in New York City, obviously. It's evident every day you walk down the street. And that's one reason why we would stay away from the small and medium-sized lenders, because they are particularly exposed there. But that's a slow-moving process, right, that takes place over years. There's not a kind of sudden stop in the commercial real estate space that would lead to a sudden and systemic crisis. So I think the risk of systemic crisis on either side of the Atlantic is quite limited. We have been holding and have held through the last 2 weeks both of our positions in the financial sector. We do think cyclicals, including financials, are attractive because they've been totally trashed over the last 2 weeks.
Ella Hoja, thank you so much. Jay Pulaski, you're sticking with us. Coming up, the morning calls, and later the dot plot doesn't matter. This Fed is done hiking. That is the view from JP Morgan's Jack Manley. He joins us around the opening bell. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Bear downgrading Caterpillar to underperform, seeing mounting headwinds stemming from the ongoing banking crisis. Next up, Deutsche Bank upgrading Corning to buy, expecting Q1 results to mark the bottom for earnings. And finally, Citigroup upgrading KeyCorp to buy, saying the risk reward looks appealing after stress testing the regional banks. Coming up, the banks rebounding amid the prospect of further U.S. support. That conversation coming up next with JP Morgan's Jack Manley. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Moments away from the start of trading, we do see a constructive tone to the markets led by the financial sector. We have seen the S&P outperform the NASDAQ, which is a departure from what we've seen over the past few sessions. 0.6% gain for S&P, NASDAQ up 0.2%. If you flip up the boards, you can get a sense of what we're seeing in the yield space, which is higher yields as people take a look at the prospect for stronger growth, a banking system that's under control. Crude just up marginally, $70.65 on the NYMEX, and a bit of dollar weakness. Euro 107.93, gaining just about 0.3%. One stock to watch at the open, First Citizens. The lender's purchase of SVB sending regional banks higher to kick off the week. The CEO writing in a statement, quote, "This has been a remarkable transaction in partnership with the FDIC that should instill confidence in the banking system." Kaylee Lyons back with us for more. Kaylee.
Well, we're seeing obviously a massive move, as you said, off the back of this, Lisa. First Citizens is getting $72 billion in assets at a discount of $16.5 billion. This acquisition will transform it into one of the top 15 banks in the country in terms of size. And we actually were just hearing from the CFO on an investor call saying that the deal brings in $35.3 billion in cash to First Citizens. And they believe some SVB clients are now going to return. So we have a nice 49% move in the shares here. It's also a big move for First Republic. Republic, up about 30% in the first moment of trading. This is after a Bloomberg report over the weekend that the government is looking for ways to extend emergency lending facilities for banks in a way that would allow the lender more time to shore up its balance sheet. Because as we know, Lisa, the balance sheet of many of these regional lenders has changed dramatically in recent weeks. We see that evidenced in the latest data out of the Federal Reserve. Essentially, what is happening is deposits are fleeing and banks are borrowing to aid liquidity. The end result is after $250 billion in bank borrowing in the week through March 15th, liabilities went up despite deposits leaving by a record $120 billion. So it speaks to the ongoing difficulty faced by regional lenders because, yes, we have the regional banking ETF up by about 3 to 4% right now at the opening bell, but it still is down by more than a quarter over the month of March, Lisa.
Kayleigh Lyons, thank you so much. Across the Atlantic, we're watching Deutsche Bank bouncing back after closing at its lowest level in 5 months. The sell-off prompting German Chancellor Olaf Scholz to publicly back the lender, saying there's no need for concern. And joining us now is Bloomberg's Jan-Patrick Burnett. What happened here? Do we have a sense of what exactly transpired and why we're seeing confidence now?
Well, it's usually pretty scary if officials have to come out and back a bank publicly. In this case, I think it's well deserved, and we have several analysts as well coming out saying Deutsche Bank is in good health and has good fundamentals. The move on Friday was probably a little bit overdone with concerns that there are any issues at Deutsche Bank. So the stock is up by about 6% this morning. Still, it's open to debate how big of an impact banks will see on their earnings if we go into a recession. So we will see how long these gains last. In other news, we learned today that Credit Suisse top management might face some scrutiny from the regulator on how they run the bank before they were taken over from UBS. And the Saudi National Bank chairman stepped down after his remarks about absolutely not backing putting further money into Credit Suisse caused the European banking crisis in the first place. So constructive environment today for European banks, but we will see how long that lasts.
And Jan-Patrick, that story with the Saudi National Bank chair, really interesting considering how much that fund has lost on their bet on Credit Suisse. Sticking with the bank, Citigroup raising its price target on UBS while reiterating its buy rating. The analyst writing, quote, "We no longer assume the company reports a statutory loss in 2023 and believe the deal will be EPS accretive on an underlying basis from 2025. The inclusion of excess capital in our valuation causes us to increase our target price to 26 Swiss francs from 24 Swiss francs previously." Still with us, Jay Pulaski of TTW. And you were talking, Jay, earlier about how you like the major banks. What about major European banks?
Yes, Lisa, we prefer the non-U.S. equity space. As you know, we're global multi-asset investors. And so our very simple shorthand is that the Fed is done raising rates. That means the dollar is going to go down, and that's bullish for non-U.S. equities. And we particularly like in the developed space, Europe, including European financials, which has been a long-standing position of ours, very cheap. Plenty of liquidity, plenty of support. The European economy is not likely to go into recession, contrary to what people have thought over the last year. We also like Japan, and in the emerging markets, we like China and Mexico. So we think there are a lot of opportunities out there, Lisa, and as we move into that high nominal growth world and avert a recession, certainly on a global basis, investors now fully cashed up are going to need to start putting that money back to work. And we think European banks, as well as broad Europe equities, are an attractive place on a 6 to 12 to 24 month point of view.
Jay, your vantage point leaves some questions, as Ella pointed out, about the bond market and what we've seen in terms of a repricing of Fed rate hikes, but also a repricing of longer term inflation expectations lower at a time when you're talking about it possibly being a higher inflation world for longer. So how much of a repricing needs to happen in the benchmark bond indexes in order to get to the place that you expect we get to?
Yeah, Lisa, that's a great point. And we're quite underweight fixed income across the board. It's roughly 30 to 40% of our benchmark, and we have about 15% allocated, virtually none in the sovereign space. We actually like credit because we don't think there's a recession coming. We like credit in both the U.S. and in emerging markets. So I think you're absolutely right. Bonds at this level are not attractive. And so bonds are going to back up as the market kind of understands that the Fed is done. We priced that part in, but now we have to price in the fact that we're not going back to that low growth, low inflation environment. And so I do think you're absolutely right. The inflation expectation side is going to need to go up, but it's not going to be the same surge that we saw from 0 to 5%, right? It's going to be, let's call it on the 10-year, 3.5 today to 4, 4.25, 4.5, which is where it was, a couple of months ago. So I think that's going to be very digestible. And as the market sees that we're going into an economic recovery, risk assets are going to be able to absorb that back up in rates quite reasonably.
Jay Pulaski, thank you so much for providing your perspective. Mega cap tech attracting investors as well, looking for shelter, and that's something that we've been seeing despite some of people calling for tech underperformance. Apple shares up almost 8% over the past month, and you can see that same kind of move, all even bigger in Google and Microsoft, 15.7 and almost 12% or 11.5% for Microsoft. Here's what eToro's Ben Liedler had to say about this.
You look for those long duration assets that benefit from lower or at least capped bond yields. And that's tech and that's traditional defensive. So I think they tick all the boxes. And the things that are going to hurt here are the more cyclical assets, the ones that, where earnings are going to fall faster than we thought.
Joining us now to discuss is JP Morgan's Jack Manley. Jack, how do you weigh in here when we see big tech outperforming after all the naysayers that in a higher rate world, this would be an area of great underperformance?
Yeah, Lisa, I think the thing that we've been trying to hammer in for a long time at this point is that it's not about the absolute level of rates so much as it's about the rate of change in those interest rates and the direction of travel. And up until this point, the direction of travel has been higher. The rate of change has been pretty significant, and we haven't really known where we were going to land. That makes it extraordinarily difficult to price those longer duration assets. Now that we have a little bit more clarity about where exactly the Fed is going to land, and I do think the Fed is basically done at this point, it could be taken as a signal by the market that, look, it's off to the races for some of these growthier companies, some of these technology-oriented companies. I'd say the messaging, though, Lisa, hasn't changed a whole lot there, and the underlying point is quality, sort of regardless of where you're looking within the equity market.
How do you distinguish quality in big tech? Does it go to social media versus nuts and bolts, iPhones and iPods, or iPads, I should say? iPods no longer exist in our rhetoric, but really this does raise a question, right? How do you identify what has staying power in a rapidly changing world?
Yeah, nuts and bolts, I like the way you put it, of physical assets that are produced by some of these companies, things that consumers are going to buy that are tangible, always something good to look at. Of course, there is room for innovation in the digital space, but what we can't be looking at here is those ultra-speculative, ultra-long-term growth stories. We need to have some, at least, whisper of the potential of profitability coming at some point in the near term, 12, 24 months, something along those lines. No longer is growth at any price a reasonable style of investment strategy, because even though the Fed may be landing a little bit quicker than we would have thought and at a lower level than we would have initially thought, the era of free money, of rates going back down to zero, I think is long behind us for quite some time. So the strategy around there has to change a bit.
There's also this issue of how do we know that we're going to get some kind of landing that's just hard enough to kill inflation, but just soft enough to allow some of these trades to continue. Morgan Stanley's Seth Carpenter weighing in on this over the weekend, saying if the disruption in the banking sector delays an extension of policy tightening, then a soft landing still is possible. But the downside risks have gotten bigger. The no landing notion never made any sense. Central banks were always going to force a landing one way or another. Jack, what's your sense of how significant this landing is likely to be if the Fed has paused where it has and we don't see more banking stress that is materially more than what we've already seen?
Yeah, I would agree, first of all, that no landing scenario is always kind of silly. We knew there was going to be a landing. We just didn't know necessarily how hard it was going to be. I can see this environment, Lisa, where the Fed is able to sort of thread the needle and figure out a soft-ish landing. And the way that I get there is by looking at what's going on with the labor market. Just an enormous amount of excess demand out there that could, in theory, be sopped up by higher interest rates. At the same time, though, we do have financial conditions tightening pretty notably on the back of this banking crisis. And we have a Fed that hiked last week, and I don't think it necessarily should have done that. It's sending the wrong signal to markets about the direction of interest rates, and that could potentially lead to a downturn in consumption as we move through this year. So I think recession probabilities have probably crept up net, given everything that's happened over the last 3 weeks. But I do still think a soft landing is possible. Biggest story here, though, Lisa, is that even if we do get a recession, given the fact that there are no major imbalances in any of the cyclical parts of the market, things like housing or CapEx, whatever recession that may come our way, I don't think is going to be particularly severe.
Let's get a little philosophical, and I apologize to everyone for this, but Jack, you just said that they were sending the wrong signal to markets last week when they hiked rates at the Federal Reserve, and yet they might have sent a signal. The market didn't get it. If the market doesn't get the signal, if the market gives you a different kind of pricing, does it matter, right? If you hike into a vacuum of people who are basically betting in the other direction, did you hike at all? You basically have 100 basis points of rate cuts baked into the market by the end of this year and early next, despite some of the pushback that we saw from the Federal Reserve. So does it matter what the Fed does if the market's basically calling their hand and not believing them?
And maybe this commentary is coming from my place as a very frustrated market strategist trying to make sense of what the Fed is doing. You know, the rhetoric out of Jay Powell last week, I just think made absolutely no sense. You know, he acknowledged that financial conditions had gotten tighter. He acknowledged that the banking crisis had added uncertainty to the environment. I don't think either of those statements justifies the rate hike. But you're right, Lisa. I mean, the markets are still pricing in cuts by the end of this year. I think we are going to sort of split the difference between what the market is saying and what the latest dot plot is telling us, which is an additional 25 basis point hike. That's why I think we're going to kind of settle out and say no more rate hikes this year, but holding steady through the end of 2023 with cuts starting to emerge in 2024.
Jack,
markets are going to come in line with this.
You said something that was really important, and I want to just follow up on this quickly. You said that it's the pace of rate hikes that matters, and if we've hit an end to the rate hiking cycle, that will give stability to a lot of names. Does it give stability to the overall index? Does it give a sense that we could potentially rally from here substantially?
I think it does. I mean, we still need to see just how hard this landing is going to be when the Fed does land. If it's a short, mild, mellow kind of technical recession, the earnings drop will not be significant, will likely be short-lived, and markets are forward-looking, Lisa, right? So perhaps they can look through maybe the next 6 months of pain and focus in on that light at the end of the tunnel. However, if this recession ends up being a little bit worse than we would expect, and if we do end up getting a pretty significant one, that has implications for earnings that aren't particularly encouraging. That means that we could see a further move lower from here. My base case is that clarity on interest rates means that we have at least a modest upward pressure on markets, but there are some things that could go wrong here, I think.
Jack Manley, thank you so much for your perspective. Coming up, big tech strengthening its ties with China, even as U.S. Sino tensions simmer.
We're talking about less tech earnings, problems with China. It's a risk. Think about semis. It's nearly a third of the semis market, and clearly this isn't helping. That's going to be shaving off some of that growth.
That conversation coming up.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Poland's finance minister. That conversation at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg.
We're talking about less tech earnings, problems with China. I mean, we could have had this conversation, 6, 9, 12 months ago. It's a risk. Think about semis. It's nearly a third of the semis market, and clearly this isn't helping. That's going to be shaving off some of that growth. What's new here, I think, is the accelerated growth slowdown, the decline in bond yields. That's what I think we're, resetting for.
Tensions flaring between Beijing and Washington with all eyes on TikTok. The U.S. just one in a growing list of countries moving to block the Chinese-owned app. This as big tech continues to strengthen its ties with China. This is the sort of duality that's going on. Apple CEO Tim Cook meeting with China's commerce minister to discuss supply chains after saying at an event over the weekend, quote, "This has been a symbiotic kind of relationship that I think we both enjoyed." Bloomberg's Ed Ludlow joining us now from San Francisco. Why is Tim Cook, Ed, going to China, going to Beijing at a time of rising tensions, and how much of a liability is it?
Yeah. because China is an increasingly important market for Apple. Wang Wentao is relatively new to his role as the commerce chief in China, appointed this year. To the best of our knowledge, Tim Cook has not visited mainland China since pre-pandemic times in 2019. This is part of the China Development Forum. It's basically the government showcase for the economy since it lifted restrictions from a COVID-0 perspective in December. Cook is not the only executive to meet with Wang Tao. Others, including the CEO of Mercedes-Benz, for example, have been. But at the end of the day, it boils down to China, Greater China, representing 20% of Apple's sales. And you kind of hit on the key point of discussion, which for Apple is supply chain. We've discussed the story endlessly on this program that in the depths of the second wave of COVID in Guangzhou, for example, Apple came to quickly realize that its supply chain was incredibly concentrated for the high-end Pro models of its iPhone handset. What has happened subsequently is Apple looking to diversify its supply chain away to nations like India and Vietnam. But for the time being, China's still important. So that was a big topic of conversation. The word stability doing a lot of work in that statement from China. But Tim Cook also visiting an Apple store and meeting with customers there in mainland China as well over the weekend.
Ed Ludlow, thank you so much. U.S.-listed China tech on the move this morning. Alibaba fluctuating between gains and losses. On the news that billionaire co-founder Jack Ma has returned to China. Joining us now is Bloomberg's Isabel Lee. Isabel.
Hi, Lisa. Yes, Ma's move resurfacing is definitely having an effect. The billionaire first disappeared from public view in 2020 after publicly criticizing Chinese regulators. But on Monday, news surfaced that Jack Ma appeared back in China, visiting a school he founded and talking to staff there about topics including like ChatGPT and others. And analysts say that Ma's reappearance will be positive for the sentiment because they say this will be a regulatory normalization. So you're right, Alibaba is fluctuating between gains and losses. We have the broader index also shedding weight. The Nasdaq Golden Dragon Index is slightly higher. We have the Hang Seng also up and MSCI China also up. So how did we get here? Jack Ma's resurfacing comes as China tries to pitch itself as a hospitable place for business, and that's after a sweeping crackdown on the tech sector, Ma's companies included. The billionaire has been traveling across the world from Vienna to Tokyo to Hong Kong, and that's when Chinese authorities persuaded him to come back and to try to make their case. But Bloomberg reports that Ma is retreated from his companies to focus on agri-tech research, so it remains to be seen. And we have Ma even telling his executives in Alibaba and Ant not to obsess too much over his return. So definitely lots of things unfolding here, but we'll look out for Chinese tech stocks.
Isabel, thank you so much. Let's take a look at some of the other price action this morning, including, and I just mentioned that the Nasdaq 100 has risen 20% from its low in December 2022. Let's head over to Bloomberg's Kaylee Lyons to take a look at what's moving today. Kaylee.
Well, Lisa, it's so interesting that headline crosses, and yet within the sector composition of the S&P 500, it is actually technology and tech-heavy sectors that are underperforming today. Granted, it is a broad-based rally. Pretty much everything is in the green, but communication services only up about 0.1%, and information technology up only by about 0.4. So that is actually underperforming the broader market, which is up about 0.8%. Toward the top of the pile, though, actually at the very top, you have the financials. The financial sector as a whole up 1.8%, and it is those regional banks outperforming. The regionals index up more than 4%, and a large part of that is thanks to the moves we are seeing in the likes of First Republic, up about 19% on more hopes of support from the U.S. government, allowing it more time to figure out its balance sheet. And then First Citizens up a whopping 43% after it agreed with the FDIC to buy $72 billion of SVB's assets at a discounted rate of $16.5 billion. Pretty good deal, and the market seems to like it today, Lisa.
Kaylee, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. As Kaylee was talking about, we are seeing a rally. And on the flip side, you are seeing yields creep just a touch higher now, looking for a 4% Fed funds rate in January of 2024. So still pricing in those rate cuts and that NASDAQ 100, even though it is underperforming the S&P today, up about 20% since its low in December. This is Bloomberg. This is Bloomberg The Open. I'm Lisa Abramowitz in for Jonathan Ferro. Taking a look at the markets, you are seeing that outperformance continue in the S&P, up to 0.6% versus a 0.3% gain that you're seeing in the NASDAQ. If you take a look at what's moving, it really is what we're seeing in the banking stocks. We are seeing yields higher, markedly higher. Two-year yields 3.95%. But if you take a look at the bank stocks, that's where the action is. First Citizens shares are absolutely roaring. 43% gain. First Republic, PacWest, Western Alliance, all surging on the heels of a bit of stability. Time now for the trading diary you need to be watching this week. Fed Governor Philip Jefferson speaking at an event from Virginia at 5 Eastern. 2 days of bank hearings on Capitol Hill kicking off on Tuesday. More Fed speak coming from Barkin and Collins on Wednesday, followed by Williams, Waller, and Cook on Thursday. And finally, rounding out the week with U.S. GDP and another round of jobless claims. What data is going to matter? Last week, we were talking about how the data doesn't matter anymore. This week, will that PCE, that core metric on inflation, really start to matter a whole bunch more? This was Countdown to the Open. This is Bloomberg.